Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Finally hit 3%. We got to go all the way back to June FOMC to see the last time that Treasury yields traded above 3%. And we did it this morning for about 20 minutes, it felt like, and we were right back below, and it seemed like the market was going to kind of use this as a resistance level, maybe test it a few times, then go back down towards 290. Lo and behold, we didn't. We held near 3% most of the day, and as I speak, we're still trading right just above 3%. And the market seems to be getting very comfortable there. So while we went from 280 to 290 range to a 280 to 3% range, now we could be looking to expand that band. Recall that May range that we saw, that 275 to 310. That could be the range that we're starting to get into, and that will be something a place the market hasn't traded in a long time, and likely will cause volatility to bid. Yes, wouldn't that be nice? We saw volatility bid late last week, held it a little bit earlier this week, and then really got crushed this afternoon. The two big events this week, I think, you have a lot of central bank meetings between the Bank of Japan, the Bank of England, and the Fed. You got the jobs number, but I think ultimately the big events this week were the FOMC statement that we got today, as well as the Treasury refunding announcement, which we got this morning. And once we got past those two events, volatility really just nosedived. The market typically isn't fearful of other central bank meetings moving our markets around. We are more of a reactor. Likewise, with the jobs number, we haven't seen really any volatility in the market around the jobs number. We used to way back when, but really going back over the last, say, 2 to 3 years, it's been pretty much a null kind of a trade. We get the number, market either initially fades it and then retraces, or the opposite, and it kind of stays inside the range, or once it does move, it then just kind of stops. So jobs hasn't given us a whole lot of volatility, but refunding announcement this morning they obviously beefed up auctions with the need for more supply coming down the road. Likewise, we got the FOMC statement, and they kind of tweaked it a little bit. The for now, things are going well for now. Gradual rate hikes will continue as long as economic data shows us what we need to see, or however it was paraphrased. And that sort of signals more of a hawkish tone. So you would have expected rates to move higher. They just kind of nudged higher a little bit. Equities kind of did the sideways trade. There wasn't a whole lot of ripple effect after the Fed announcement. We are expecting the Fed to continue to raise, definitely in September, and most likely again in December. And then it becomes very cloudy as to 2019. The Fed wants to raise rates. They want to continue gradual rate hikes, and they're going to start adding press conferences at every meeting. They're going to start being much more transparent. But what does that really mean when we have things like trade war coming in, and we have tariffs going up, and tariff back and forth between China and the U.S.? Who's going to tariff the worst, or who's going to retaliate the worst? And it's going to weigh on the market here eventually. It hasn't as of yet. So right now, 10-year note Treasury yields at 3% for the first time since the end of June. We had a big beef to supply coming in via the refunding announcement. And likewise, we have a very positive jobs number coming ahead on Friday. So things looking towards 10-year note yields possibly testing that 310 level sooner than later. However, it's all going to come down, I think, to the yield curve, which, while it did see a modest steepening, it remains very flat, and that is something the Fed has to keep its eye on if it wants to continue those rate hikes gradually or other. This is Todd Colvin coming to you from the floor of the CME Group.